Hey there, Iggy the Investing Iguana here. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with a total of 370,000 reads. Are you looking for some high-yield REITs to add to your portfolio this March 2024? Well, you're in the right place. In today's video, I'm going to share my top 6 REIT picks that are poised to perform well even in this high inflation, rising rate environment. We'll look at why REITs can be a smart addition to your portfolio right now and break down the key metrics for each of my top picks. I'll explain it all in plain English, so even if you're new to REITs, you will walk away an expert. Make sure to stay tuned until the end, because I'll also be sharing a bonus tip on what to watch out for when investing in REITs this year. Let's dive in. So, just a heads up, the U.S. Federal Reserve, or the Fed as we like to call it, has thrown a bit of a curveball our way. They've hinted they might not cut interest rates until after June 2024. And guess what? This news sent stocks tumbling initially, as investors had hoped for rate cuts sooner to support economic growth and asset prices. However, for long-term income investors, this pullback could present an opportunity to accumulate high-quality, dividend-paying Singapore REITs at more attractive valuations. While higher interest rates can increase borrowing costs for REITs and put pressure on property values in the short term, many REITs have already locked in lower rates and termed out their debt in anticipation of rate hikes. Moreover, Singapore's economy and real estate market fundamentals remain relatively resilient. Sectors like industrial, logistics, suburban retail, and specialized assets like data centers are benefiting from structural demand drivers. As long as the Fed engineers a soft landing and avoids a severe recession, well-managed REITs with strong sponsors and healthy balance sheets should be able to weather this period of uncertainty and continue delivering steady distributions to unit holders. Investors can consider gradually accumulating REITs that are trading at discounts to their net asset values and offering distribution yields above the historical average of around 6%. Now, let's dive a bit deeper into the concept of inflation. Inflation is a term that might sound complex, but it's essentially a measure of how the prices of goods and services that we purchase are changing over time. When inflation is high, the cost of everything from groceries to housing tends to rise. On the other hand, when inflation is low, prices increase at a slower pace and may even fall. The Federal Reserve, or the Fed, is the central bank of the United States, and one of its main jobs is to keep an eye on inflation. The Fed uses inflation data to make decisions about interest rates. If inflation is high, the Fed might raise interest rates to slow down the economy and bring inflation back to their target level. Conversely, if inflation is low, the Fed might lower interest rates to stimulate the economy. In January 2024, the inflation rate cooled down to 3.1%, a slight drop from December's rate of 3.4%. This means that, on average, the prices of goods and services increased by 3.1% compared to the same month in the previous year. Even though this rate was higher than what some people expected, the Fed decided not to cut interest rates just yet. This decision by the Fed can have various implications. For consumers, it could mean that borrowing costs, such as mortgage rates or credit card interest rates, might not decrease. For investors, it could affect the returns on their investments, especially for those who invest in bonds or other fixed-income securities. However, it's important to remember that these decisions are made with the overall health of the economy in mind. The Fed's goal is to maintain stable prices and maximum employment, and their decisions on interest rates are a key tool in achieving that goal. So, while the news about inflation and interest rates can sometimes seem concerning, they're part of the Fed's strategy to manage the economy. For those of us who are focused on the long term, market fluctuations aren't just minor inconveniences, they're opportunities. They provide us with the chance to invest in high-quality real estate investment trusts, REITs, that offer attractive dividends. REITs are companies that own, operate, or finance income-generating real estate, and they're required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends. Now, when it comes to selecting which REITs to invest in, it's not a process to be taken lightly. It's important to review and filter potential investments based on certain criteria. These criteria might include the current yield, which is the annual dividend payment divided by the market price of the stock. It gives you an idea of the income you might receive for every dollar invested. Another important factor to consider is the price-to-earnings (PE) ratio, which is a valuation ratio calculated by dividing the market value per share by the earnings per share (EPS). A lower P/E ratio could indicate that the stock is undervalued, although other factors should also be considered. The price-to-book (PB) ratio is another useful metric. It compares a company's market value to its book value, providing insights into the intrinsic value of the company. A lower PB ratio could suggest that the stock is undervalued. Market capitalization, or market cap, is also worth considering. It's the total market value of a company's outstanding shares of stock. Larger companies with higher market caps are often considered more stable and less risky, although they may offer lower potential returns. By using these criteria to filter potential investments, you can narrow down the field and avoid having to sift through every single REIT out there. However, it's crucial to remember that these metrics are just a starting point. They can help identify potential investments, but it's essential to dig deeper. Look at the company's financial health, the quality of its real estate portfolio, its management team, and its growth strategy. AIMS APAC Reit. Sporting a 7.72% dividend yield and a price-to-equity of 13.896. It's like the dark horse of the race with a market cap of SGD1B. Now, let's break this down a bit. When we talk about dividend yield, we're basically looking at how much money you're getting back in dividends compared to the price you paid for the stock. In this case, AIMS APAC Reit is offering a pretty juicy 7.72% yield. That means if you invested $1,000, you could expect to get around $77.20 back in dividends each year. Not too shabby, right? But dividend yield isn't the only thing we should look at. We also want to consider the price-to-equity ratio, or PE for short. This ratio compares the price of the stock to the company's earnings. A lower PE ratio could mean that the stock is undervalued, while a higher ratio might suggest that it's overvalued. AIMS APAC Reit's PE ratio of 13.896 is actually pretty reasonable, suggesting that it might be a good value for the price. Now, I mentioned that AIMS APAC Reit is like the dark horse of the race. What I mean by that is that it might not be the biggest or most well-known REIT out there, but it could still have a lot of potential. With a market capitalization of SGD1B, it's a mid-sized player in the game. But sometimes, it's the smaller, lesser-known companies that can surprise us with their growth and returns. One thing to keep in mind with REITs is that they're required to pay out at least 90% of their taxable income as dividends to shareholders. That's why REITs often have higher dividend yields compared to other types of stocks. But it also means that they may have less cash on hand to reinvest in growth or weather tough times. So, when you're evaluating a REIT like AIMS APAC Reit, it's important to look at factors beyond just the dividend yield and PE ratio. You'll want to consider things like the quality and diversity of its property portfolio, its debt levels and financial health, and the overall economic and real estate market conditions. Lendlease REIT, rolling in with a 7.61% dividend yield and sitting pretty with a price-to-equity of 18.645. This one's got a market cap of SGD 1.4B. Alright, let's dive into what makes Lendlease REIT an interesting player in the REIT game. First off, that 7.61% dividend yield is nothing to sneeze at. It means that for every $100 you invest, you could potentially earn $7.61 in dividends each year. That's a pretty sweet deal, especially if you're looking for a steady stream of passive income. But what about that price-to-equity ratio of 18.645? Well, this is where things get a little more nuanced. A PE ratio of 18.645 is a bit higher than AIMS APAC Reit's ratio of 13.896, which we talked about earlier. This could suggest that Lendlease REIT's stock price might be a bit overvalued compared to its earnings. However, it's important to remember that PE ratios can vary a lot depending on the industry and the specific company. In the world of REITs, a PE ratio in the high teens isn't necessarily a red flag. It could just mean that investors are willing to pay a premium for Lendlease REIT stock because they believe in the company's growth potential and the stability of its dividend payouts. Speaking of growth potential, let's talk about that market cap of SGD 1.4B. This puts Lendlease REIT in the mid-cap range, which could be a sweet spot for investors. Mid-cap companies are often big enough to have established track records and strong financials, but small enough to still have room for growth and expansion. So, what exactly does Lendlease REIT do? Well, as the name suggests, it's a real estate investment trust that's managed by Lendlease, a global property and infrastructure group. Lendlease REIT's portfolio includes a mix of retail, office, and mixed-use properties across Singapore and Australia. This diversification could help spread out risk and provide a more stable income stream for investors. Frasers Centrepoint Trust, a solid choice with a 7.56% dividend yield and a market cap that's through the roof at SGD4B. Now, let's talk about why Frasers Centrepoint Trust might be a REIT worth considering for your investment portfolio. First and foremost, that 7.56% dividend yield is pretty impressive. It means that if you invested $10,000 into this REIT, you could potentially earn around $756 in dividends each year. That's a nice chunk of change that could help supplement your income or even pay for a fancy dinner or two. But what really sets Frasers Centrepoint Trust apart is its massive market capitalization of SGD4B. In the world of REITs, that's like being the big kid on the block. A larger market cap generally means that the company is more established, has a longer track record, and may be less volatile than smaller, newer REITs. So, what exactly does Frasers Centrepoint Trust invest in? Well, as the name suggests, it's a retail REIT that owns and manages a portfolio of shopping malls and commercial properties across Singapore. Some of its notable properties include Causeway Point, North Point City, and Waterway Point. These are all prime locations that see a lot of foot traffic and consumer spending. Investing in a retail REIT like Frasers Centrepoint Trust could be a good way to gain exposure to the broader consumer sector without having to pick and choose individual retail stocks. Plus, with a large and diversified portfolio of properties, the REIT may be less impacted by any single tenant or property underperforming. Of course, no investment is without risk, and REITs are no exception. The retail sector has faced some challenges in recent years, with the rise of e-commerce and changing consumer preferences. Malls and brick-and-mortar stores have had to adapt and find new ways to attract shoppers and stay relevant. But Frasers Centrepoint Trust seems to be navigating these challenges well. It has a mix of suburban and downtown malls, which cater to different demographics and shopping needs. It has also been investing in asset enhancement initiatives to upgrade its properties and keep them fresh and appealing to shoppers. Another thing to consider with REITs is their price-to-earnings (PE) ratio. Frasers Centrepoint Trust has a PE ratio of 17.491, which is fairly in line with other retail REITs in Singapore. This suggests that the REIT stock price is reasonably valued relative to its earnings. So, if you're looking for a reliable dividend payer with a strong market presence and a track record of weathering market challenges, Frasers Centrepoint Trust might be worth adding to your watch list. Just be sure to do your own due diligence and consider how it fits into your overall investment strategy and risk tolerance. Mapletree Pan-Asia Commercial Trust, this one's got a 6.72% dividend yield and a giant market cap of SGD 7.2B. Alright, let's take a closer look at this big player in the REIT game. Mapletree Pan-Asia Commercial Trust, or MPAC for short, is like the Godzilla of the Singapore REIT world with that massive SGD 7.2B market cap. That's a serious amount of money, and it tells us that this REIT is no joke. But what about that 6.72% dividend yield? Well, it might not be as high as some of the other REITs we've talked about, but it's still pretty darn good. To put it in perspective, if you invested $100,000 into Impact, you could potentially earn $6,720 in dividends each year. That's enough to pay for a nice vacation or maybe even a fancy new gadget or two. Some of Impact's notable properties include Vivo City, Mapletree Business City, and Festival Walk. These are all prime commercial locations that see a lot of business activity and consumer spending. And with a portfolio that spans multiple countries and property types, Impact may be less impacted by any single market or sector underperforming. But of course, investing in a commercial REIT like Impact does come with some risks. The office sector, in particular, has faced some challenges in recent years with the rise of remote work and flexible working arrangements. And retail properties have had to adapt to changing consumer behaviors and the growth of e-commerce. However, Impact seems to be taking steps to stay ahead of these trends. For example, it has been investing in asset enhancement initiatives to upgrade its properties and make them more attractive to tenants and shoppers. It has also been exploring new property types, such as data centers, which could help diversify its income streams. Another thing to consider with Impact is its price to earnings (PE) ratio, which sits at 19.56. This is a bit higher than some of the other REITs we've discussed, which could suggest that the stock is slightly overvalued. However, it's important to remember that PE ratios can vary a lot depending on the industry and the specific company, so it's not always an apples-to-apples comparison. Overall, if you're looking for a REIT with a strong market presence, a diversified portfolio, and a decent dividend yield, Mapletree Pan-Asia Commercial Trust might be worth considering. Just be sure to do your own research and think about how it aligns with your personal investment goals and risk tolerance. And hey, if you ever find yourself shopping at Vivo City or working in Mapletree Business City, you can give yourself a little pat on the back and think, I own a piece of this. But maybe don't say it out loud, or people might think you're a bit weird. PARAGON REIT, bringing up the rear with a 6.12% dividend yield and a market cap of SGD 2.3 B. Now, I know what you might be thinking. 6.12% dividend yield? That's the lowest one on the list. Why are we even talking about this PARAGON REIT? Well, hold your horses there, because there's more to this story than just the dividend yield. First of all, let's talk about that market cap of SGD 2.3 B. Sure, it might not be as massive as some of the other REITs we've discussed, but it's still nothing to sneeze at. In fact, a market cap of over SGD 2B puts PARAGON REIT firmly in the mid-cap range, which could be a sweet spot for investors looking for a balance of stability and growth potential. But what exactly does PARAGON REIT invest in? Well, as the name might suggest, it's all about that prime retail real estate. PARAGON REIT owns and manages a portfolio of high-quality retail properties in Singapore, including the iconic Paragon Shopping Mall on Orchard Road. If you've ever been to Singapore, you know that Orchard Road is like the mecca of shopping, and Paragon is one of the crown jewels. Investing in a retail REIT like Paragon can be a good way to gain exposure to the consumer sector and tap into the spending power of Singapore's affluent population. And with a focus on high-end, luxury retail, PARAGON REIT may be less impacted by some of the challenges facing the broader retail industry, such as e-commerce and changing consumer preferences. Of course, no investment is without risk, and PARAGON REIT is no exception. The retail sector can be sensitive to economic downturns and shifts in consumer sentiment. And with a relatively concentrated portfolio focused on a single property type and geographic market, PARAGON REIT may be more vulnerable to any localized market disruptions. But PARAGON REIT does have some things going for it. For one, it has a strong sponsor in SPH REIT, which is backed by Singapore Press Holdings, a major media and property conglomerate. This could provide some financial stability and access to resources that smaller, independent REITs may not have. Additionally, PARAGON REIT has a relatively low price-to-earnings (PE) ratio of 17.083, which suggests that its stock price is reasonably valued relative to its earnings. This could be attractive to value-oriented investors who are looking for a good balance of income and growth potential. So, while PARAGON REIT might not have the highest dividend yield on the block, it does offer some unique advantages and a focus on a specific niche within the retail REIT space. As with any investment, it's important to do your own research and consider how it fits into your overall portfolio and risk tolerance. Mapletree Logistics Trust, offering a 6.21% dividend yield and a hefty market cap of SGD 7.3 B. Now, let's dive into the world of logistics with Mapletree Logistics Trust, or MLT for short. This REIT is like the big rig of the Singapore REIT highway, with a massive market cap of SGD 7.3 B. That's some serious weight to throw around. But what exactly does a logistics REIT do? Well, imagine all the stuff you buy online or in stores. All those products have to get from the factory to the warehouse to the store shelves somehow, right? That's where logistics properties come in. MLT owns and manages a portfolio of logistics properties across Singapore, Australia, China, Hong Kong, Japan, Malaysia, South Korea, and Vietnam. These properties include warehouses, distribution centers, and even some high-tech cold storage facilities. Investing in a logistics REIT like MLT can be a way to tap into the growing e-commerce and global trade trends. As more and more people shop online and businesses expand their supply chains across borders, the demand for high-quality logistics properties is only going to increase. And with a diversified portfolio spanning multiple countries and property types, MLT may be well-positioned to capitalize on this growth. Now, let's talk about that 6.21% dividend yield. Sure, it might not be the highest yield on the list, but it's still pretty attractive, especially considering the size and stability of MLT. To put it in perspective, if you invested $100,000 into MLT, you could potentially earn $6,210 in dividends each year. That's a nice little income stream that could help fund your online shopping habit or maybe even a trip to one of the countries where MLT operates. But of course, no investment is without risk, and MLT is no exception. The logistics industry can be sensitive to economic downturns and trade disruptions. And with a portfolio that spans multiple countries, MLT may be exposed to currency fluctuations and geopolitical risks. However, MLT does have some things working in its favor. For one, it has a strong sponsor in Mapletree Investments, a leading real estate development, investment, and capital management company. This could provide access to pipeline properties and financial support that smaller, independent REITs may not have. Additionally, MLT has a relatively low price-to-earnings (PE) ratio of 13.684, which suggests that its stock price is attractively valued relative to its earnings. This could be appealing to investors who are looking for a good balance of income and value. Overall, though, I believe REITs focused on industrial, logistics, and necessity-based retail properties are well-positioned in this environment. Their tenants tend to have more pricing power to pass on higher costs. Selective office and residential REITs could also do well as people return to cities. The key is to think long-term. While no one knows exactly when the Fed will cut rates, current REIT valuations seem to be pricing in a lot of negativity already. For patient investors, this could be a great entry point to lock in attractive yields and wait for the upside. And if you stayed until here for the bonus tip, here are some of my tips for REIT investing for 2024. One important thing to watch out for when investing in REITs in 2024 is the quality and safety of their dividends. With economic uncertainty still lingering, some REITs may be at risk of cutting their payouts if rental income declines or they face higher expenses. To mitigate this risk, focus on REITs with strong balance sheets, low debt ratios, and diversified tenant bases. REITs with investment-grade credit ratings and long-term leases with high-quality tenants tend to have more stable cash flows to support their dividends. Also pay attention to each REIT's payout ratio, which is the percentage of earnings or cash flow paid out as dividends. A lower payout ratio means the REIT is retaining more cash to reinvest in growth or cushion against downturns. In general, a payout ratio below 80 to 90% is considered safer. Finally, keep an eye on how different real estate sectors are performing. While most REITs are benefiting from lower interest rates, some property types like retail malls and offices are still facing challenges from e-commerce and remote work trends. In contrast, sectors like industrial warehouses, data centers, cell towers, and life science facilities are seeing strong demand growth that could drive outsized returns. So be selective and align your REIT picks with the evolving economic landscape. Alright, so those are my top 6 REIT picks for March 2024. Just remember, while high yields can be tempting, it's important to look under the hood at metrics like price to FFO, debt ratios, and portfolio quality too. REITs can be a great way to add some steady income to your portfolio, but they're not without risks, especially in a volatile macro environment like we have today. As always, be sure to do your own research and never invest more than you can afford to lose. If you found this video helpful, let me know by smashing that like button and sharing it with a friend who's interested in income investing. And if you want to see more content like this, be sure to subscribe to the Investing Iguana channel and ding that notification bell so you never miss an update. I'm Iggy the Investing Iguana, and I'll see you in the next video. Happy investing!